Welcome. Today we're diving into the world of real estate investment trusts or REITs. If you've ever wondered how to invest in real estate without buying property directly, REITs might be the answer. They offer a way for everyday investors to access the real estate market, often with lower barriers to entry and greater diversification. In this video, we'll break down what REITs are, how they work, and why they might be a smart addition to your investment portfolio. Let's get started by understanding the basics of REITs and what makes them unique in the world of investing. Real Estate Investment Trust or REIT is a company that owns, operates, or finances income-producing real estate. Think of it as a mutual fund, but instead of stocks or bonds, it holds properties like office buildings, shopping malls, apartments, and hotels. REITs allow individuals to invest in large-scale, income-generating real estate without having to buy or manage properties themselves. This structure makes real estate investing more accessible and liquid for the average investor. REITs were first established in the United States in 1960, created by Congress to give all investors the opportunity to invest in large-scale, diversified portfolios of income-producing real estate. Before REITs, only wealthy individuals or institutions could access these types of investments. The introduction of REITs democratized real estate investing, opening the doors to a much wider audience and allowing more people to benefit from the income and growth potential of real estate. REITs pool money from many investors to purchase and manage a portfolio of real estate assets. Investors buy shares in the REIT, and the REIT uses that capital to acquire properties or finance real estate projects. The income generated from rent, leases, or mortgage interest is then distributed to shareholders, usually in the form of regular dividends. This setup allows investors to earn a share of the income produced by commercial real estate without having to buy, manage, or finance properties themselves. There are several types of REITs, each focusing on different aspects of real estate. Equity REITs own and operate income-producing properties. Mortgage REITs, on the other hand, provide financing for income-producing real estate by purchasing or originating mortgages and mortgage-backed securities. Hybrid REITs combine both strategies. Understanding these types helps investors choose the REITs that best match their investment goals and risk tolerance. Equity REITs are the most common type of REIT. They own and manage income-producing real estate such as office buildings, shopping centers, apartments, and hotels. The primary source of revenue for equity REITs comes from leasing space and collecting rents on the properties they own. These REITs may also profit from selling properties that have appreciated in value. Equity REITs offer investors a way to participate in the ownership and income of real estate without direct management responsibilities. Mortgage REITs or MREITs focus on providing financing for income-producing real estate. Instead of owning properties, they invest in mortgages and mortgage-backed securities. Their income comes primarily from the interest earned on these financial assets. Mortgage REITs can be more sensitive to interest rate changes, which can impact their profitability. They offer a different risk and return profile compared to equity REITs, making them an important option for diversification. Hybrid REITs combine the characteristics of both equity and mortgage REITs. They may own and operate properties while also investing in mortgages and mortgage-backed securities. This approach allows hybrid REITs to diversify their sources of income and potentially reduce risk. Investors in hybrid REITs benefit from both rental income and interest income, making them a flexible option for those seeking a balanced real estate investment. REITs generate income primarily through rents, leases, and interest on mortgages. Equity REITs collect rent from tenants, while mortgage REITs earn interest from the mortgages they hold. Some REITs also profit from selling properties that have increased in value. The income generated is typically distributed to shareholders as dividends, providing a steady stream of cash flow for investors. This makes REITs attractive for those seeking regular income. One of the defining features of REITs is their requirement to distribute at least 90% of their taxable income to shareholders as dividends. This rule ensures that most of the income generated by the REIT is passed on to investors, making REITs a popular choice for those seeking regular income. The high dividend payout is a key reason why many investors include REITs in their portfolios, especially those focused on income generation. Like direct real estate investments, many REITs are publicly traded on major stock exchanges. This means investors can buy and sell shares of REITs just like stocks, providing a level of liquidity that's rare in traditional real estate. This liquidity allows investors to quickly adjust their portfolios in response to market changes, making REITs a flexible and accessible way to invest in real estate. REITs have made real estate investing accessible to a broader range of people. You don't need large amounts of capital to get started, just the ability to buy shares through a brokerage account. This democratization of real estate investing means that anyone can participate in the growth and income potential of commercial properties, regardless of their financial background. Investing in REITs can help diversify your portfolio. Because REITs invest in a wide range of properties and geographic locations, they can reduce the overall risk of your investments. Real estate often behaves differently than stocks or bonds, so adding REITs to your portfolio can help smooth out returns and provide stability during market volatility. REITs are managed by experienced professionals who handle property acquisition, leasing, maintenance, and sales. This means investors benefit from the expertise of real estate professionals without having to manage properties themselves. Professional management can lead to better property selection, efficient operations, and potentially higher returns for shareholders. Publicly traded REITs are subject to strict regulatory requirements and must regularly disclose financial information. This transparency helps investors make informed decisions and ensures that REITs operate in a fair and accountable manner. Regulatory oversight also protects investors by setting standards for reporting and governance. REITs have a unique tax structure. They don't pay corporate income tax on earnings distributed as dividends as long as they meet certain requirements. However, dividends received by investors are typically taxed as ordinary income, not at the lower qualified dividend rate. It's important for investors to understand the tax implications of REIT investments and consult with a tax advisor if needed. Investing in REITs is different from owning property directly. With REITs, you don't have to worry about property management, maintenance, or tenant issues. Instead, you own shares in a company that handles all those responsibilities. This makes REITs a more passive and convenient way to invest in real estate, especially for those who prefer not to deal with the day-to-day challenges of property ownership. Many investors hold REITs in retirement accounts like IRAs or 401(k)s. This can offer tax advantages such as tax-deferred growth or tax-free withdrawals depending on the account type. Including REITs in your retirement portfolio can provide diversification and a steady income stream, which is especially valuable for retirees seeking reliable cash flow. Like any investment, REITs come with risks. Property values can fluctuate, and economic downturns can impact rental income and occupancy rates. Interest rate changes can also affect mortgage REITs and the value of REIT shares. It's important to understand these risks and consider them when deciding how much of your portfolio to allocate to REITs. Interest rates play a significant role in REIT performance. When rates rise, borrowing costs for REITs can increase, potentially reducing profits. Higher rates can also make other income investments more attractive, which may lead to lower demand for REIT shares. Conversely, falling rates can benefit REITs by lowering financing costs and boosting property values. REITs, especially those traded on stock exchanges, can experience price volatility similar to stocks. Market sentiment, economic news, and changes in interest rates can all cause REIT prices to fluctuate. While this volatility can create opportunities for investors, it also means that REIT values can decline during market downturns. Some REITs specialize in specific sectors, such as retail, healthcare, or industrial properties. Each sector faces unique risks. For example, retail REITs may be affected by changes in consumer behavior, while healthcare REITs depend on trends in the medical industry. Diversifying across different types of REITs can help manage these sector-specific risks. Investing in REITs is straightforward. Most REITs are listed on major stock exchanges, so you can buy shares through a brokerage account just like you would with any other stock. There are also REIT mutual funds and exchange-traded funds ETFs that provide exposure to a diversified basket of REITs. This makes it easy to add real estate exposure to your investment portfolio. REIT exchange-traded funds, ETFs, and mutual funds offer a convenient way to invest in a diversified portfolio of REITs. These funds pool money from many investors and invest in a range of REITs, spreading risk across different property types and locations. They are traded on stock exchanges and can be bought and sold throughout the trading day, just like individual stocks. In evaluating REITs, consider factors such as the quality of the properties, the experience of the management team, dividend history, and the REIT's financial health. Look at metrics like funds from operations, FFO, occupancy rates, and debt levels. Doing your homework can help you choose REITs that align with your investment goals and risk tolerance. Key metrics for analyzing REIT performance include funds from operations, FFO, net asset value (NAV), and occupancy rates. FFO measures the cash generated by REIT's operations, while NAV estimates the value of its assets. High occupancy rates indicate strong demand for the REIT's properties. These metrics provide insight into a REIT's profitability and growth potential. REITs can be a useful hedge against inflation. As the prices of goods and services rise, so can rents and property values, which may boost REIT income and share prices. This inflation protection is one reason why some investors turn to REITs during periods of rising prices. REITs aren't just a U.S. phenomenon. Many countries have adopted similar structures, allowing investors to access real estate markets around the world. Global REITs provide exposure to international properties and can further diversify your investment portfolio, spreading risk across different economies and markets. Some REITs focus on properties that have a positive social impact, such as affordable housing, healthcare facilities, or green buildings. These REITs allow investors to align their investments with their values, supporting projects that benefit communities and the environment while still seeking financial returns. Technology is changing the real estate industry, and REITs are adapting. Some REITs invest in data centers, cell towers, and other technology infrastructure. These tech-focused REITs benefit from the growing demand for digital connectivity and can offer unique growth opportunities compared to traditional property types. Environmental, social, and governance (ESG) factors are becoming increasingly important in investment decisions. Many REITs are adopting ESG practices such as energy-efficient buildings and transparent governance. ESG-focused REITs appeal to investors who want to support sustainability and responsible business practices while seeking competitive returns. REIT performance can vary depending on the economic cycle. During periods of economic growth, demand for commercial real estate tends to rise, benefiting REITs. However, during recessions, property values and rental income may decline. Understanding how REITs respond to different economic conditions can help investors make informed decisions. Demographic trends such as population growth and urbanization can influence the demand for different types of real estate. REITs that invest in sectors aligned with these trends, like residential or healthcare properties, may benefit from long-term growth opportunities. Keeping an eye on demographic shifts can help investors identify promising REIT sectors. As more people move to cities, the demand for commercial and residential properties increases. REITs that focus on urban real estate can benefit from this trend, capturing growth in office space, apartments, and retail locations. Urbanization is a powerful force shaping the future of real estate investment. Aging population increases the need for healthcare facilities, senior housing, and specialized real estate. REITs that invest in these sectors can benefit from demographic shifts, providing essential services and stable income streams. This trend highlights the importance of sector selection when investing in REITs. The rise of e-commerce has transformed the real estate landscape. Industrial REITs that own warehouses and distribution centers are benefiting from the surge in online shopping. As retailers need more space to store and ship goods, these REITs are well positioned for growth in the digital economy. Hospitality REITs invest in hotels and resorts, making them sensitive to travel trends and economic cycles. When travel demand is high, these REITs can generate strong income. However, they can also be vulnerable during downturns or disruptions like pandemics. Understanding the unique risks and rewards of hospitality REITs is important for investors. Office REITs own and manage office buildings, relying on demand from businesses for workspace. Trends like remote work and flexible office arrangements can impact occupancy rates and rental income. Investors should consider how changes in the workplace might affect the performance of office REITs. Residential REITs invest in apartment buildings, single-family homes, and other housing. They benefit from steady demand for housing, but are also affected by factors like rent control, local regulations, and economic conditions. Residential REITs can provide stable income and long-term growth potential. Retail REITs own shopping centers, malls, and other retail spaces. They depend on consumer spending and the health of the retail sector. The shift to online shopping has challenged some retail REITs, but those with high-quality locations and strong tenants can still perform well. Industrial REITs focus on warehouses, distribution centers, and manufacturing facilities. They benefit from trends like e-commerce and global trade, which increase demand for logistics and storage space. Industrial REITs are often seen as growth-oriented investments in the real estate sector. Healthcare REITs invest in hospitals, medical offices, and senior living facilities. They benefit from the growing demand for healthcare services, especially as populations age. These REITs can provide stable income and are less sensitive to economic cycles than some other types of REITs. Specialty REITs invest in unique property types such as self-storage, data centers, cell towers, or timberland. These REITs offer exposure to niche markets and can provide diversification beyond traditional real estate sectors. Specialty REITs often respond to specific industry trends and demands. Sustainable investing is gaining traction, and many REITs are focusing on green buildings and environmentally friendly practices. These REITs aim to reduce energy consumption, lower emissions, and create healthier living and working spaces. Sustainable REITs appeal to investors who want to support environmental goals while seeking financial returns. Wrap-up real estate investment trusts, or REITs, offer a unique way to invest in real estate without owning property directly. They provide access to a wide range of property types, regular income through dividends, and the benefits of professional management and diversification. While REITs come with risks, understanding how they work can help you decide if they're a good fit for your investment strategy. Thanks for watching, and we hope you now have a clearer understanding of REITs and their role in the world of investing.